What's up everybody, Nate here, and there is a ton of unrest in the global banking system right now after the fallout from Silicon Valley Bank, Signature Bank, and Credit Suisse, and that is leading many to try to figure out which bank is going to be the next to fail. And over the weekend, many investors turned to one of the largest banks in Germany, Deutsche Bank. Deutsche Bank triggered a ton of red flags from investors and bank depositors after it hit an all-time high for its credit default swaps. That essentially caused the shares of Deutsche Bank to flatline, as many investors worried that the same thing that happened to Credit Suisse investors was about to happen with Deutsche Bank. Now let's kind of break this down from the top. So if you look at what happened with Credit Suisse was investing in a lot of real estate projects and a lot of startups and other sort of businesses all throughout the entire world. They had a ton of different dealings that they do, and some of those dealings had to do with credit default swaps. A credit default swap is basically a protection measure for the bank. So if the bank was to loan out, say, $1,000, and whoever they loaned the money to ended up defaulting on that loan, well, they would swap out that debt for an insurance company. So the bank would be protected and it wouldn't have to pay that money back. It would fall on the insurance company. Well, in recent years, Credit Suisse's credit default swaps were hitting a record high, and this had to do with rising interest rates, but asset prices going down, and that led to a lot of unrealized losses for the bank. So all of the money that Credit Suisse was giving out was getting really expensive, and that meant that all of the credit default swaps were also getting really expensive. At some point, the insurance company isn't going to have all of the money to protect Credit Suisse, and that is exactly what ended up happening. It started to sell off a lot of its assets, and it went into a big deficit and had to get saved by another bank. Now, there was a lot of different startups and founders and individual investors who had money in Credit Suisse. They had a lot of Credit Suisse bonds that were connected to these credit default swaps, mortgage-backed securities, all of these different assets. Well, when the bank got sold and scooped up by UBS, all of those assets essentially became worthless. We're talking $17 billion worth. Now it looks like a similar situation is happening with Deutsche Bank. Its credit default swaps hit a record high, and that is worrying investors that the same path that Credit Suisse went down is now happening to Deutsche Bank. Basically, these credit default swaps are only profitable for a bank if whoever is paying back the debt continues to pay back the debt. That way, the insurance company never has to get involved, and there is no triggering event like a default that triggers the insurance company to come in. But with rising interest rates and startups making a lot less money in 2023, it looks like some of them are starting to default on their loans. And it looks like all of the money that Deutsche Bank has taken on in its own debt is getting a whole lot harder to pay off. Now, Deutsche Bank might start racking up a lot more losses, and if it was to go down a similar path as Credit Suisse, well, that means that all of the investors who have money in that bank and all of their money tied up in mortgage-backed securities and these credit default swaps are also going to be left on the hook if there was some sort of acquisition. That caused a lot of investors to pull out immediately, which caused the share price of Deutsche Bank to crash. They were scared that they were going to lose their money like a lot of the Credit Suisse investors. Now, it's worth mentioning here that since then, Deutsche Bank and a lot of German officials have said that the banking sector in Germany is really strong and that Deutsche Bank is a profitable bank versus Credit Suisse was losing a ton of money. They weren't really making a profit. They had a lot of losses and they were starting to sell their money, and depositors were taking their money out. So the bank was essentially collapsing, similar to what happened with Silicon Valley Bank and Signature Bank. However, it's also worth mentioning that the same things can be said about Silicon Valley Bank and Signature Bank and Credit Suisse right before their collapse. Government has a duty to its people to not stir up panic, right? If the government says a bank is about to collapse and the banking sector is no good, then everybody's going to run to the bank and pull their money out. So it's not that the government is lying here, but they may know a little bit more than we do. Now, it's not to say that at this point Deutsche Bank is on the verge of collapse, but it definitely could go down the same route as Credit Suisse. It really just depends on how high interest rates get in Europe, and it depends on all of the businesses and other banks and startups and everybody else that took on money with Deutsche Bank and their ability to pay that money back. If they're not able to, then the bank is going to run into similar problems. Now, here in the United States, First Republic Bank is also going through it, as it is a regional bank that is having a lot of trouble because millions of Americans are starting to pull their money out of banks. Over the last few weeks, nearly $100 billion has been pulled from regional banks and major banks in the United States. Now, the the bank's ability to survive depends on how much funds it has in its own bank. And if people are pulling their money out in mass, then the bank doesn't have any money to go out and invest or make a profit. It also doesn't have enough money to return all of the funds for everybody that has money in the bank. That's because banking in the United States works on a fractional reserve system, and this means that banks are only required to keep a fraction of their depositors' money on hand at all times. Basically how it works is you create a savings account at a bank and deposit $100. Well, the bank doesn't just sit on that $100, it's a liability to them. It's losing money to inflation, and they just have to hold cash. So what do they do instead? Well, they go out and invest this money so they can make a profit. They invest in things like mortgage-backed securities. That's why they take on credit default swaps to protect themselves at the hundreds of billions of dollars level. They also invest in startups, and they take that money and loan it out to other people so they can get more mortgages or personal loans or just anything. The bank does all of that with your $100. Now, normally if you go right back to the bank and ask for your $100 back, the bank made $10,000 from your $100 investment. So yeah, they can give you that small piece back, no problem. However, if everybody goes back to the bank all at once and asks for their $100 back, well, now the bank isn't going to have enough because most of its money is tied up in assets. And if those assets haven't matured or gained in value yet, well, then they're going to take on losses and they're not going to have enough money to even survive. That's what happened to Silicon Valley Bank and Signature Bank, and it's the reason why they ended up collapsing. Now, in the United States, we have something called FDIC, or the Federal Deposit Insurance Corporation, and that protects depositors up to around $250,000 if the bank were to fail. So all depositors would get $250,000 if the bank collapses. And this goes for any bank that is in the FDIC system, so major banks, small banks, you name it. For many of the banks in the United States, though, most of the funds that they have, we're talking 80% plus, are in uninsured funds. So if the bank was to collapse, FDIC would only protect around 20% of depositors' money, which means 80% of depositors would lose all of their cash. All that money is completely lost, which means businesses don't have enough money to pay their employees. Without banks, nobody can really create a startup or take on a loan to get a mortgage, take on a loan to create a business, nothing. That completely goes away. Not to mention, any business that relied on consumer spending is going to have a lot less of it now because everybody just lost their savings. Which leads to things like the government stepping in, and that is exactly what happened with Silicon Valley Bank and Signature Bank. Now, initially, these two banks went under, and the United States Treasury Department and the Federal Reserve devised a plan. They were going to assess a special one-time fee on all banks in the FDIC system. That was going to fund enough money to give back all of the depositors who may have lost money when those banks collapse. Banks make money from people depositing money in those banks. Basically, the banks are going to pay this fee with depositors' money. And in the future, to assure that this doesn't happen again, that the federal government has enough money in case it does happen, they could end up charging banks a much higher fee for being in the FDIC system. And that means that some of the major banks all throughout the country may end up passing those costs onto you, the consumer. But now the United States government has taken one step further because Silicon Valley Bank is still hanging around and it still has a ton of losses on its assets. Recently, the government struck a deal with First Citizens Bank to take over the majority of Silicon Valley Bank's assets, and now First Citizens Bank is one of the largest banks in the United States. Basically, what happened was First Citizens Bank purchased around $70 billion of Silicon Valley Bank's assets, except for because a lot of these assets had appreciated in value, and the government wanted to keep the assets in the private system rather than being managed by the federal government. They sold the assets to First Citizens Bank at a discount, and First Citizens only ended up paying around $16 billion for them. Now, a lot of these assets are junk assets, but some of them are still decent enough for Citizens Bank to want to hold on to and continue to appreciate in value over time. And as long as the bank is relatively stable and a lot of depositors aren't pulling their money out right away, then those losses are unrealized, meaning they don't really mean anything until you actually cash in that investment. A realized loss means that you lost money today, but an unrealized loss means that you could lose money if you were to sell that asset. And to be fair, there is still around $90 billion worth of Silicon Valley Bank's assets that the federal government is holding on to. The big issue that we're facing not only in the United States, but in across the entire world has to do with those unrealized losses. A lot of banks and investors and startups and businesses in general have invested aggressively over the last few years. You gotta remember, we had near 0% interest rates for almost 2 straight years. Not only that, but the Federal Reserve was buying a ton of corporate bonds to help out the stock market and a lot of businesses so they could expand during uncertain times like the pandemic. Plus, we had a lot of stimulus payments and Americans having a bigger income so they could go out and spend money. All of that led to record profits and a lot more investment by businesses and banks. Now, with interest rates going way up, they're pretty much just as high as they were just before the Great Recession in 2008. These banks and startups and businesses are taking on huge losses. In fact, US banks right now have a combined $1.7 trillion in unrealized losses. That means that if we were to see a massive run on the majority of US banks, well, now no bank in the United States would be able to support it, and pretty much all of them would collapse. A bank can try to free up liquidity if there is a run on the bank. So like I said, it only has a fraction of that money on hand, but it can sell off an asset and get that money right away. However, it wouldn't be able to recoup a lot of its depositors' funds because it's sitting on a ton of losses. Sure, those losses might become gains over the next couple of years, but right now, banks are taking a huge L. It is really difficult to say which bank could be the next bank to fail. It could be First Republic Bank, it could be Deutsche Bank. We just don't know because nearly every bank across the world has huge unrealized losses right now. And as investors start to burn through all of their cash because profits are low and investors invest a whole lot less, that means these businesses are not going to have nearly as much money to put into the bank. That means less funds for the bank to invest. And Americans are getting hit by inflation right now and a whole slew of other things, which means they're also burning through their own savings, which means banks don't have any money to get any profits. That could lead to higher lending standards and higher fees for all of the depositors in the bank. And at the end of the day, just a lot less money for average consumers. I don't have the bank's financials in front of me, so I can't tell you which bank is going to be the next one to fail. But what I can tell you is it is extremely important for you right now to be financially educated, especially when it comes to where you do your banking. Banking isn't going away, so you just need to try to find a bank that you can trust and put your money in it in a smart way. The bank does not have your best interest in mind. The bank is there to make money, and you are there to try to protect yourself. It's not a bank's job to educate you. It's a bank's job to make money, just like it's not a mortgage broker's job to try to get you the best mortgage. They want to make money at the end of the day, and it's your job to be educated in your financial decisions and on how you spend your money. So try to do as much research on your bank as possible. Try to find a bank that you can trust. Go talk to a banker and figure out which bank is the best bank for your money right now. Learn how the banking system works so that way you can bank the right way instead of the way that your banker wants you to. We're breaking down topics like that 7 days a week, as well as everything going on in the business and financial world on this channel. So if you haven't subscribed yet, be sure to do that before you go. And if you want to stay up to date with everything going on in the business and financial world 7 days a week, we're talking local economy, global economy, the stock market, you name it. We're breaking all of it down over on Market Briefs, and you can subscribe right now for free by clicking the link in this corner right here. That is it from me, everybody. Be kind out there, and I'll see you all in the next one.